Hello, and welcome to Portfolio Matters Weekly Update, week 48. And it has been yet another volatile and sadly exciting week in the market. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. A bit of housekeeping before we get going. First of all, thank you to everyone who turned up to our drink during the week, which also turned into dinner afterwards and was great. Richard and I really enjoyed it, and we will be doing it on a quarterly basis. And also, thank you to all our donors. We have used some of the money to buy Richard a new microphone. So hopefully the sound problems will have are at an end. Okay, news this week. Well, it's been a very volatile week as the new Omicron variant from South Africa has caused ructions and has led markets to expect further disruptions. So we will take you through actually how in Europe there are further lockdowns leading to a decline in activity, and the markets are worried that lockdowns will recur around the world with predictable consequences. Now, the Fed have discovered inflation and have been talking about accelerating tapering. So they're printing money slightly less fast than they intended to. OPEC has stuck to its previously agreed schedule of supply increases. So we'll increase production by 400,000 barrels a day in January after lobbying from the White House, apparently. And finally, the US debt ceiling has been kicked down the road, and the crisis will now occur in February as opposed to the 15th of December. Okay, so this week's economic data. So we had some inflation numbers from Germany and the Eurozone, and it wasn't good. So German input prices rose to 21.7% in October, which was well up on September and beat expectations by a decent margin. The inflation rate in Germany hit 5.2% in November, up from October, and again ahead of expectations. And the harmonized rate, now I'm not entirely sure what it's harmonized with, but anyway, that hit 6%, well up on October and well ahead of expectations. And that is a big concern. How long before Germans start badgering the Bundesbank to badger the ECB to stop printing and start raising rates? And when that happens, the periphery will no longer have their bonds being bought in size by the ECB, and we could well see a return of the Eurozone crisis. In the UK, car production was minus 41.4% year on year, which was essentially unchanged from September, but is not getting better, and it was well below expectations. So supply chain disruptions are still causing big disruptions for manufacturers. Mortgage lending was 1.6 billion, which was well down on September and well below forecasts. Consumer credit was 0.7 billion, which was well up on September and ahead of forecasts. And lending to individuals was 2.3 billion, which is well down on September and below expectations. So that's not very reassuring. Now, the house price index in the UK was up 10% year on year, which was up on October and defied expectations of a decline in the growth rate. In China, we had reassuring PMIs. So the manufacturing PMI came in at 50.1. Remember, 50 is average normal activity. So neither expansion nor contraction. So it came in at 50.1, which means a small expansion, and that beat expectations. Non-manufacturing came in at 52.3, again beating expectations. And so the composite came in at 52.2, which was well ahead of expectations. EU inflation came in hot, 4.9% in November, above October and beating expectations, sadly. And core leapt up to 2.6%, well ahead of October and again ahead of expectations. The EU, the unemployment rate for October was 7.3%, which is a small decline on September and below expectations. So the Eurozone, as of October, was doing fine, but we will soon show you some charts showing that the lockdowns are starting to have an effect on activity. In the US, the house price index has been shooting up this year, up 19.1% in November, which is down on October and below expectations, but still very elevated. The ADP employment change showed 534,000 jobs added in, I think actually that's October, not November, down from September and slightly below expectations. But the ISM manufacturing PMIs for November was 61.1, which is up on October and essentially matching expectations. Now, last week, we mentioned that the PMIs did not seem to, which were very positive, did not seem to be being impacted by input price inflation. And so we were saying that manufacturers and service companies did not seem to be being squeezed. Now, one of our Discord viewers, Innocenti67, who is a fund manager, we all know, who turned up to the drinks, but wishes to remain anonymous, pointed out the reason that the PMIs don't reflect input price inflation is because it's a composite of 5 surveys, and none of which include the input price inflation. So those surveys are new orders, output, employment, suppliers' delivery times, and stocks of purchases. So if inflation affects new orders or output, then you would have a knock-on effect with PMI, but it does not measure explicitly in input price inflation. Okay, so some charts. Richard?
Thanks, Keith. UK consumer credit has it has recovered entirely from the COVID deficit, and it's bumping along a little bit below its pre-COVID average level, which is a sign that the economy is doing okay. And there's more confidence. Mortgage lending has sort of fallen off a cliff, hasn't it? And we know that we've got 10%, as Keith just said, 10% UK house price increase over the past 12 months. And you wonder how that's going to continue when mortgage lending is really, really down. And maybe that's a harbinger of problems to come in the housing market. We shall see. UK net lending to individuals, the same thing is happening. People are drawing in their horns. So consumer credit's gone up slightly. Net lending to individuals peaked post-COVID and is now back down to 2013 levels. And the trend is clearly at the moment downwards. And that again is not good news for the overall economy. German inflation rate, we talked about this last week. I remember it had that little tick down last week. We were wondering where it was going to go. Well, it's gone up another 1%. It must be last month, in fact, that we talked about it. But it is shooting up. And we know that the German government, the German people, the Bundesbank are all very concerned. They had about inflation. They have a national memory of hyperinflation prior to the First and Second World War, and they do not want to go there again. And I think it's going to be having increasing tension between the ECB and the German government and the Bundesbank going forward. China manufacturing PMI, as Keith said, it's neutral. China non-manufacturing PMI above 50, but it is following a gentle downward trend, which suggests the economy is possibly slowing somewhat there. China general PMI is slightly going up, but it's difficult to tell exactly where it is. It's sort of below the very steady expansion that it had between 2017 and 2020, but it's sort of mucking around in the low 50s. EU inflation looks very like the German inflation graph, and it's showing absolutely no signs of flattening out, and the policymakers must be very worried in private. EU core inflation, you rather wonder what on earth they haven't got in core inflation that they should have, because 2.5 versus the figure we've just seen makes no sense.
Well, they exclude energy and food, amongst other things, both of which are shooting through the roof, Richard.
Yeah. It's a sort of pointless measure, isn't it? Case-Shiller house price index in the US, as Keith said, the US house prices have gone up very substantially, 19-20%, I think it was. And that's this graph showing it. Employment change, it has stabilized at actually what is almost a pre-pandemic level, which suggests a stable employment environment now in the US. US PMIs are good and suggest a strong economy. US initial jobless claims seem to be settling down over the last few weeks, and suggests that the US economy is finding a baseline, I think, over the last couple of months.
I'd also say that these are extraordinarily low levels. I mean, last week, when you had 199,000 initial jobless claims, that was the lowest level since 1969, I believe. So, the US labor market's incredibly strong.
Yeah. And US continuing jobless claims is continuing to fall, following a fairly straight line down. The EU unemployment rate is low and falling.
By European standards, I should say, Richard. Nothing compared to the US standards, but these are good numbers, compared to the 12% we had after the great financial crisis.
Yeah, it's just a strong economy, a strong European economy.
Yeah. Now, when we started doing the podcast, we meant to update fairly regularly about where we were in the cycle, and our Discord viewer, Richard Wilk, reminding us we've failed to do this. So quickly going through the clocks, which I've updated, but I should caveat that with saying there is, I think, a great deal of uncertainty at the moment. So we are currently in mild but rising inflation, and really this clock is anywhere between 9 and 11. And the big uncertainty about inflation is how persistent it's going to be. Now, there's a lot of supply chain disruption, which is leading to goods price inflation, but service inflation is picking up. The labor market is incredibly tight. And we know in the US that there are more job openings than there are unemployed people seeking a job. And the real question is, how much pricing power do workers have? If they can demand higher wages, you will get a wage price spiral and inflation will be persistent. Richard, your thoughts?
Yeah, I agree, Keith. I think we don't yet know whether we're moving into a wage price spiral. I mean, the commentators who you do hear talking, saying that we are not in a secular inflationary environment. I think the single factor that they don't appear to consider is the effect of labour shortages on it. And I think that we are in grave danger of moving into wage price spiral. I also know up at 12, we've got what should you invest in high inflation: gold, commodities, and foreign currencies. Well, that assumes that you're living in a country with high inflation, and there are other countries who you can invest in who are not experiencing high inflation. Clearly, if at the moment, the US, Europe, the UK, we're all experiencing high inflation, and you would expect the currencies to remain on that basis alone, roughly sort of pari passu. So there is a great deal of uncertainty about inflation, and it's always possible to argue that the supply constraints will revert, mining production will alleviate itself, oil production will go up, or demand will fall. And yes, that's always possible, and you can't predict. It's very difficult to predict those items going forward, but it certainly hasn't reversed so far. And my view is the longer the trend is established, the less of a one-off it becomes, and the more of a general problem we start to have, and we move to a sort of secular inflation. And the other thing, final point is, there are those who say that demographics point to continuing deflation, global deflation, over the next 20 or 30 years. And what that doesn't do is it doesn't obviate an inflation spike lasting several years for exogenous reasons within that overall deflationary trend.
Actually, on the demographics, Richard, if you have an aging population and you have a smaller workforce who are expected to provide services for that enlarged dependence ratio, then you'd expect that all the old people with cash will have to bid up for the services of the fewer workers. And that is a key argument in the great demographic reversal by Goodhart and Pradhan, he says, looking at the spine of his book. So it's not clear that demographic shifts will actually be disinflationary, particularly if you print enough money.
I think the argument for the demographic shift is that as you get older, you purchase fewer goods, and that's probably true. But you don't necessarily purchase fewer services, which I think is your point, Keith.
Yeah.
In fact, you start to purchase more services because your healthcare needs and so forth go up. And I haven't read the book myself, but if you just assume that inflation is caused by goods and there is no labor inflationary element, then I think you're missing the point of what's happening now.
Yeah, absolutely. The other thing I would say is that modern monetary theory has been a big trend over the last few years, people talking about essentially how governments should not be constrained in their expenditure by a budget deficit, but rather by the effect on inflation. So if there's no inflation, you can basically spend as much as you like, and then you should start reining back expenditure as inflation picks up. Now, I think that recent events have shown the drawbacks of MMT in that inflation's picked up, but essentially nobody wants to change their behavior because changing behavior is difficult. So you've seen even the central banks, who are quite nimble, have basically ignored inflation as it's gone way beyond their forecasts, and we'll show you some charts in a bit. So the idea that governments would change their expenditure and social programs, etc., all of which are very hard to do when inflation picks up, I just think is a fantasy.
You also get, effectively, you get pro-cyclicality if you do that, because the economy adapts to the additional money that's being put into the economy via effectively printing money. And then when the economy looks like it's overheating, you start to withdraw the money, fine, so you move into a recession, and you have to continue to withdraw the money through the recession, and you get a reinforcement of that recessionary process. And it's the age-old problem is it is, if you print money, you debase the currency. If you borrow money, you're pulling forward economic activities from the future till now. And at some point, the economy needs to re-equilibrate. And my view is that MMT simply fails to address the fundamental issue that we have too much debt in the economy.
No, well, I agree. They put in a lot more debt if you had MMT, but I disagree with the pro-cyclicality, Richard, and it should be well, the opposite of that. What's that? Anti-cyclical, in that when inflation picks up and the economy is running hot, you start withdrawing fiscal stimulus. But then there would be a lag before that starts coming through in the inflation numbers. And you could also, what happens when you get stagflation? Anyway.
Yeah.
This is the business cycle clock. Now, in the business cycle clock, I have a great deal more confidence because I think we are undoubtedly in the early stages of an expansion. We have consumers, as you will see in the charts as we go through, have money in the bank, as do businesses. Interest rates are astonishingly low. Real interest rates are something like -5%. And, if the governments of the world will just get out of the way and remove the COVID restrictions, I think this economy should be self-normalizing very strongly. And the OECD are forecasting very good economic growth next year, as we will show you.
Yeah.
Richard, anything to add?
No, I think you've enumerated it very well, Keith. I think we are, as you say, we went through a very short, sharp trough. And we now appear to be in a very expansionary phase. You just have to look at the US PMIs and the European employment rates, for example.
And finally, the oil cycle. Well, I think, again, we are at the bottom, towards the bottom, and starting a new cycle. Even though the oil price has risen very strongly from the bottom, we are as yet seeing absolutely no increase in investment. And that,
I'm not entirely clear that we are in this cycle anymore, Keith. I think we may have come out of it because I don't know that we're going to head up towards peak investment. Did you? In the news this morning, that Shell has withdrawn from the Shetland, a large Shetland oil field, because basically of the reputational damage it will cause itself. And I just wonder that peak investment will not happen. It may happen in many years' time when the world is totally struggling for lack of fossil fuels. I don't know, but I suspect the paradigm's changed somewhat.
Well, you could well be right, Richard, but in that case, I think we're in deep trouble. I mean, we'll show you later when we look at the European energy crisis, which is going to be a problem this winter, we fear, that the UK still generates about half its electricity from fossil fuels, mainly natural gas. And if we don't invest, we are in trouble. And when we talk about the business cycle, this is a chart from Lynn Alden, which shows the difference between the US 10-year yield and the 3-month yield. And famously, this is a great predictor of future recessions because when it dips negative, you get a recession soon after, and the recessions are marked in gray. So whenever the indicator has gone below zero, a recession has soon followed, and currently is not indicating any problem at all. So the business cycle looks set well fair. Okay, on to inflation watch. Now we had another couple of pieces of information this week. So EU inflation came in hot. 4.9% CPI, 2.6% core, and German CPI came in hot as well, 5.2%. We haven't yet got the core number. Now, the Fed has talked about tapering, but we haven't got any details, and it is still doing a lot of money printing and will continue to do so until mid next year. Now, what they think they're achieving with all this money printing when the economy is doing very well and unemployment is low and there are more jobs than there are people looking for jobs, I really can't see, but they're still doing it.
You wonder if there's some imperative that's driving them that isn't apparent to us. or whether they simply they don't want to cut it off. I believe if they cut it off sharply, they foresee some very unpleasant response in the financial markets.
Yeah, well, but that's it, Richard. Now their target seems to be not the US economy, but financial markets.
Yeah. Here's the Italian PPI, which is above 25%. It's just extraordinary, isn't it? And look at the steepness of that rise in the last month or so.
Yeah.
Last 2 months. And that is just very, very unpleasant, because it will feed through into consumer prices, or businesses will go bust. They can't, you can't take that on as a business and reduce your margins to that extent.
Yeah. No, a reminder, PPI stands for Producer Price Input Inflation. So this is what companies are paying for their inputs.
And the ECB balance sheet. And the ECB have said they are not going to withdraw QE, and they're not going to increase interest rates, because I actually don't know why, but clearly they are feeding inflation, and very dangerous. I could see that the rift in the European monetary system may well be caused by inflation and the fact that the Germans need to exit from the policies of the ECB, and the disastrous inflation figures that are likely to come through in the next months.
Well, I think a point you previously raised, Richard, is that the ECB is trapped. The moment they stop buying all the government bonds of Greece and Italy, then we get a resumption of the Eurozone crisis, I think.
Yes, we do. And they are buying all of those bonds. So this one, Keith and I were just talking about this earlier. Basically, we think the chart was probably created on the basis of what the ECB would like inflation to be going forward, as opposed to what they're forecasting it to be. Because they're just works of magnificent pieces of fiction, I would say. It's like they took the sharp upward line, early 2021, and decided it needed to come down. But so lo and behold, it comes down, and then it's got a almost right angle change in it. I mean, it's just nonsense, isn't it?
Yeah, that's
presumably they know it's nonsense.
So the dashed line is the ECB's forecast for inflation as of September, and as Richard was describing, I mean, the real inflation has done nothing like it, and the ECB has made zero policy change.
I do a little bit of financial modelling, sort of professionally, nothing particularly complex, but I do know that it's possible to build a model where you can tweak what look like entirely realistic parameters in concert to produce an entirely unrealistic output. Agricultural commodities versus food prices. Food prices in green or pale blue, not sure which it is, and food prices are inevitably going to follow the yellow line up, which suggests that there is 40 or 50% of inflation coming in food prices, maybe more. And ammonia prices. Ammonia is feedstock for fertilizer production, and fertilizers obviously necessary to maintain global food production. And fertilizer cost has gone up nearly fivefold in the last 12 months or so.
Yeah,
which is bound to be knocking through into. It'll either cause lower food production because farmers can't afford fertilizer, or their food production will stay constant and the input price for food will go up. Either way, more food price inflation coming.
Yeah. Now, just a reminder that ammonia, so this ammonium nitrate, is made via the Haber-Bosch process, which basically just uses vast quantities of natural gas, and natural gas prices are going through the roof. And in Europe, they've closed down various fertilizer factories because, frankly, we just don't have the gas. And we will go through the European gas market in a bit, and it's not looking very good.
US personal consumption expenditure. Inflation is the highest in 30 years. This graph goes back to the 1990s. And Well, it's they are heading up, and we see some leading indicators like food price index, which has continued to head up. So one suspects that this is going to continue in that direction at least for a while. Inflation is being driven by COVID disruption. So someone has put together an index of COVID sensitive sectors as to driving inflation. I'm not sure how useful that is. I think it's an exercise.
Well, it is the Federal Reserve Bank of San Francisco. So, but again, the white line essentially is what they say COVID disrupted sectors. I mean, that includes essentially all manufacturing goods, because that's like the supply chain. So, I don't see how you can't avoid it. What they're saying is once COVID disruptions cease, then that will disappear and that's transient. But
I think they work the other way around, Keith. I think they say COVID has caused inflation. Which sectors have inflation? Therefore, they go in the COVID sensitive sector, and the others stay in the blue sector. So I think they have developed an index which is a self-fulfilling prophecy.
Yeah, the ghost of Arthur Burns in action.
Yes, exactly. Yeah.
Yeah. Now I'm showing you this chart, but I don't know how to interpret it. Basically, this chart is showing that checkable deposits and currency held by in the US has absolutely gone through the roof. So if we go back to 2020, you'll see that checkable deposits were less than 1 trillion. And according to this chart, it's now at 3.5 trillion. So it's more than trebled. And the Bloomberg is from data. The data is from Bloomberg. And if that's true, then US consumers have absolutely vast resources, which they are spending. And, as long as they have those resources, then of course you're going to get very high inflation. But we then have this chart from John Authors at Bloomberg showing the Americans' cash in the bank grew by 35% over the last 2 years. So how come this is showing that their cash has trebled? I'm just not sure how to interpret these two charts. Certainly, they're both consistent with Americans having a lot more cash in hand and in the bank. So if anyone can explain this, please get in touch and drop us a line on Discord or put a comment in the on YouTube, please. Richard.
Americans haven't bought this much stuff in a decade. So this is showing real retail sales, which have the white lines adjusted retail food sales. And so the white line is showing the amount of stuff that Americans are buying, and it is rapidly increasing, and this is a reflection of the amount of money that they've got, and it is possibly an indicator as to why there are these supply chain disruptions, because demand is exceeding supply, demand is exceeding manufacturing capacity, and it's exceeding the ability of ports to unload ships, which is all contributing to inflation as well. Obviously, China benefits from exports, and China manufacturing has basically gone back to pre-COVID levels. That strengthens the Chinese yuan, and the question is, it is so strong that is it going to cause a problem with the US? I think the US got very upset with the Chinese, didn't they?
Well, they got upset with the Chinese because the yuan was too low, and so exports were too high. So, but what this is showing is, excess demand for Chinese manufactured goods is driving up the yuan, and as a result, exports are getting more expensive. So, as another inflationary input. As we've seen, US consumers have a lot of cash. They have been consuming mainly goods as opposed to services due to they're not allowed to go to a restaurant. They haven't been. And that means there's been huge amounts of trade, world trade. And that's caused the supply chain disruptions, such as trying to get all that trade through ports, has led to long delays and increases in prices. But what this chart shows is the increase in world trade is now bumping up against hard constraints. So will those supply chain problems be persistent, and therefore will inflation be persistent? So this is the waiting time at the Panama Canal, and you can see it's going through the roof because you can't really increase the size of the Panama Canal without a huge deal of capital investment. And we talked about goods price inflation, but service inflation is also rising. Although
and that suggests pay rates are rising, doesn't it?
Yep. As we've covered in previous weeklies, US wage rates are rising. And just to reiterate what we've just covered, so services expenditure is below trend, goods expenditure is way above trend.
So this chart shows that long-term consumer inflation expectations remain well anchored. So the white line is the long-term expectations and the blue line is the actual inflation figure, CPI. And the interesting thing is that so far, long-term expectations haven't really been affected by this sharp spike in inflation.
No, I agree. I don't know why the blue line just stops. Anyway, it shouldn't do.
It looks like they're not quite lined up, doesn't it?
Yeah. Okay, on to emerging markets. And emerging markets are not having a good time. So this is an index of emerging market currencies against the dollar, and it's just hit a new low. And I thought this was really interesting charts from John Authors. So in the during the COVID recession, governments all around the world massively increased their fiscal stimulus to support their citizens and the economy. Now, in the emerging markets, they are now having to rein back their expenditure. And the left-hand chart shows the expected cut in the fiscal budget over the years 22 to 24. And the right-hand chart shows the cut in, so the planned budget fiscal expenditure in 2024 relative to pre-COVID, so 2018, 2019. And you'll see that emerging markets are actually having to cut their budgets below pre-COVID levels. And that is particularly true for Turkey, Brazil, South Africa, Myanmar, and even India. Actually, India's there. That's Indonesia. So, and these are not small numbers. That's 2% of GDP. In the years ahead, emerging markets are going to have to go through austerity. And this is a chart which just shows the how emerging markets, having printed a load of money and run budget deficits, how their currencies have declined essentially over the last couple of years. Although the developed markets in blue have printed loads of money and run huge budget deficits, and their exchange rates really haven't changed very much relative to the rest of the world. The same is not true for emerging markets. Turkey and Brazil have seen their exchange rates absolutely collapse. And as a result, emerging markets have been a really poor investment over the last decade.
It makes you wonder if now is a good time to buy emerging markets, doesn't it? Because being contrarian can be an effective investment strategy. What do you think, Keith?
No, actually, Richard, I think they're going to have austerity. They're, in the case of Turkey in particular, they seem extraordinarily mismanaged.
Yeah.
And, and the same is true in Brazil. I mean, the politics are a mess. And I don't know, I think it's not yet, is that my fundamental opinion.
Yeah.
Okay, on to the Eurozone. Richard.
Well, this is an interesting chart that was in the FT. It shows the visitor stores and restaurants, leisure hubs by different European countries. And what is happening, zero is the pre-COVID baseline. And having sort of got up to pre-COVID baseline in the summer, they're all now falling off again. Of course, as you know, Austria has a lockdown, so clearly that has plummeted. But it just does not bode well for the European economies going forward. And every time this happens, it inflicts more damage on the economy. And to some sense, it's a little bit, possibly a little bit like a death from 1,000 cuts. And economies can't keep taking this sort of hit continually without suffering severe damage, I think.
Well, the governments are going to have to start stepping up their fiscal stimulus again. If you're mandating lockdowns, and the restaurants won't be able to survive unless you give them some money.
Yeah, but as we know, Spain and Italy, they can't. The ECB is already buying all of their debt, I think, pretty much. In fact, more than all of their debt, I believe. And so the Eurozone is in a bind in this respect. Countries across Europe are tightening their restrictions in response to, one, the Delta variant, which has reappeared with a vengeance in Europe, but also the concerns about the Omicron variant.
What I find interesting about this chart, Richard, is it seems to suggest, and this is from the FT, that restrictions are tighter in Germany than they are in Austria, and Austria has announced a lockdown. So
yes, it does. It's also confusing. It uses different colors for the countries to the previous graph.
Yeah,
because Austria was green in the previous graph.
Good point.
German restaurant, in the same vein, German restaurant bookings have fallen below the pre-COVID zero line substantially in the last few weeks.
The big fall, almost 50%.
Yes, and flight numbers are dropping back. Or flight numbers never got back to the pre-COVID levels, and my view is they probably never will, actually, with the change in behaviour of particularly business travel. And but anyway, notwithstanding that, the lockdowns and the concern about the Omicron variant have dished another blow to the European travel industry.
Okay, on to other charts. Now, we mentioned earlier that the OECD predictions for next year are really strong. So they're forecasting 2022 growth of 4.5%, 2023 of 3.2%. These are good numbers. And if you're interested, pause and have a look. But, India, 8.1%, these are strong.
This is reinforces Keith's view that we are at the start of the expansionary phase, going back to the economic cycle clock.
Yeah. But in the markets, we've had a very volatile week, and fear is back over Omicron. But all the indications I've seen, Richard, but you know more about this, is that Omicron seems to be very mild. A lot of the people they've tested had no symptoms at all.
Yeah, I think that's right, and I think there appears to be at least some defense by the vaccines that we currently have against Omicron. There's a theory that I know nobody knows the answer to these questions. There's a theory that if you catch Omicron, you get a mild disease, but you help give yourself immunity to the Delta variant, which may well be true and would be useful. I think the problem, I guess, is not, if Omicron is mild, that's great. The problem is it has 50 mutations, and it shows that there is huge capacity, for variants to come up over the next years, some of which will probably be quite benign, and some of it which may be far less benign. And I was listening to the radio yesterday, Today program, and the announcers who seemed to be expressing astonishment that we might have to have vaccinations in the years to come. And for me, it goes with, we are going to have to be vaccinated against coronavirus for many, many years, at least an annual vaccination. I don't doubt it. And we just have to get used to it.
Yeah.
And hopefully our immunity will slowly improve. But it has huge capacity to mutate and to produce new variants.
And on that new cheery note, we'll move on. Right.
Good for pharmaceutical companies.
Yes, I know. Well, that's the thing. One of the reasons there was a sell-off were Pfizer talking about, we're going to need a new vaccine, says Pfizer, biggest vaccine manufacturer in the world. Yeah. I mean, we need all of our products, says. Anyway, don't get me started. Right. So the Oecd Misery Index, I thought this was entertaining because this is combination of high inflation plus high unemployment. And actually, Turkey, Brazil not doing very well, but then some surprising entries. Spain, Greece, and the country that's doing best in the world is the one that we all in the West complacently talk about as an economic basket case, Japan. And Japan has very high GDP per capita and astonishingly low unemployment. So, on this index, they're doing very well. Thank you very much.
So the misery index is the sum of the inflation rate and the unemployment rate.
Yeah. Now, various indicators of US consumer sentiment show that US consumers are feeling pretty miserable about life. That's the green line, which is the Michigan consumer sentiment line. But they're still spending. Personal consumption has got back to trend. So, perhaps that's the whole country's doing retail therapy.
That's it. They're miserable, so they're going out and buying stuff to make themselves feel happier, Keith.
Yeah. And various indicators, all the indicators are showing that recently US consumer confidence has been falling, high house prices, rising inflation. So I found this chart astonishing. It basically shows that in the 3 years between 2011 and 2013, China consumed almost 50% more cement than the US did over the century between 1900 and 1999. And I've checked, and Chinese cement consumption did peak then, but has only come off a little bit. It's still consuming vast quantities.
So can I just point out that Keith is in fact a closet reader of the International Cement Review. He has attributed it to Robert Armstrong, but I think Robert Armstrong has actually never heard of this publication.
Yeah. Thank you, Richard. COVID. You can do these.
We've sort of done COVID, but just a quick trip through. This is actually the same graph as last week, but it's the daily new cases in South Africa. And I think they have more cases, but we're not hearing of some ghastly situation in South Africa with uncontainable new cases. England and Wales deaths registered. So we do have excess deaths still in the population. It's slightly above, and presumably this is due to COVID, but it also may be due to COVID's knock-on effects on the efficiency and operational capacity of the NHS. Hard to differentiate between the two.
That's a very good point, Richard, because actually hospital waiting times in the UK is an all-time high. Okay, on to the checklist. Well, it's a volatile week, but actually the all share, as of this morning, was up on the week, up 0.7%, Stocks Europe up 0.2%. The S&P, and bear in mind the S&P hasn't opened yet on Friday, is down 2.6% on the week, NASDAQ down 2.9%, Topics in Japan down 1.4%, Bitcoin up 2%. So it has actually been a resilient safety haven. And sterling was down 0.3%, dollar index down 0.1%.
Yeah.
So this is an hourly chart of the FTSE over the last week, and it has been extraordinarily volatile. It had a big sell-off last Friday, and then it's bounced around as fears of Omicron have waxed and waned. This is the NASDAQ, and the NASDAQ, even prior to this week, had come off its peak. And is this finally the NASDAQ rolling over? And this is VIX, which obviously has had a spike as volatility has picked up. And obviously the return of Omicron has been very, very bad for travel stocks. But it's been a difficult week for the market, but you know, the S&P is still up 25%. I mean, really?
I know, it's extraordinary, isn't it? It's like it's become so short term. And you know, I was reading something, it could drop to 4,400, I read the other day. And I looked at the chart and I thought, well, 4,400 is like 3%. So what's the big deal?
Yeah. But sadly for us, and this was a topic of conversation in the pub on Wednesday night as we met our Discord members, you know, all of us are value investors, and it's been bad. Growth has continued to outperform value. Although the area in the red circle is the period around .com. And, you know, when you have a big sell-off in growth, value massively outperforms, and fingers crossed, that is what we're heading back to.
Because that's what we're invested for.
Well, that's right. Exactly. Talking our own books.
Yes.
But, you know, this chart just shows the correlation between inflation and anything has completely broken down. Essentially, all our financial assets are just completely ignoring inflation. Sorry.
No, I was just going to say, mostly because interest rates haven't changed, I suspect.
Yes. Well, exactly. The correlation between interest rates and inflation has basically disappeared. Now, one thing that I follow is the Capex cycle, and I mainly do this in oil, as regular viewers will know. So what this shows is that works, basically. The bars, so the tan bars, are the change in global capex compared to depreciation. So when it's more positive, you're doing more capex than depreciation. When that is above zero, then essentially that tends to mark the peak of the cycle, and subsequent returns tend to go negative. So when there's too much capex, you're building excess capacity, and in future years, returns are likely to go negative. Now, currently, we're in no danger of that because capex is low and falling. And the NASDAQ seems to have peaked, but the ARK, the Cathie Woods tech ETF, has had a very poor run, and it's not getting better. Now, this morning, Ali Baroid sent us this. This is a really interesting chart that shows the sales to enterprise value ratio of software stocks is double what it was at the peak of the tech bubble.
It's extraordinary, isn't it? 20-ish.
Yeah. Richard.
Thanks, Keith. So as we know, that we've had a very choppy, bouncy, volatile, well, probably month really in cryptocurrencies. So, but they've been very bouncy and volatile within a range, and Ether is actually very close to its all-time high, despite moving up and down by about 10% over the last couple of weeks, which is quite disarming for you if you happen to be invested in it. You just have to hang on and stick with your, keep the faith, I think. And Bitcoin is showing a similar chart, really. Very, very volatile, hasn't really gone anywhere. Is a little bit further below its all-time high. But we, personally, I remain invested for invested is possibly not the right word. I remain
yes.
engaged involved
Yeah.
for a little while longer, I believe.
Okay, on to energy markets, and it was a big week. So WTI was down 9.6%, and at its bottom, was down something like 24% from its recent peak. And so that 9.6% includes a little bounce over the last day. Dutch natural gas futures, and we are going to talk about this in some depth, they are not coming down. They're up 0.3% on the week and up almost 400% year to date. Coal drifted off a bit, down 1.9% on the week, but still up 93% on the year. Uranium coming off, down 3.5% on the week, but up 50% on the year. Okay, so this is the crude oil chart showing the huge sell-off last Friday, further sell-off midweek over Omicron fears, and also fears actually that the OPEC were going to continue raising output, which they did. And then the moment they raised output in line with expectations, the market had a bounce. So sell on. Gone.
I was thinking, I read a précis of an article that was written by Goldman Sachs oil analysts, who basically said that the release of the increased output by OPEC made no difference to their projections for the oil price over the next few years, and that they see a very substantial increase, notwithstanding any small incremental increase in the output of OPEC.
Yeah, you mean increase in the oil price, which is?
Yes, yeah.
Okay, so these are charts showing the various forecasts for oil demand. Now, remember, earlier in the year, all the forecasts were for oil demand to massively decline going forwards on the green transition. I find it very interesting that the EIA have now changed their mind and now forecasting oil demand to keep on rising. So, there's the takeaway from this chart is the different forecasters have completely different outlooks for future oil demand. There's a great deal of uncertainty.
But surely, I mean, the AEB one is suggesting that from this point onwards, oil demand is going to drop. Well, it's not.
Yeah.
The OPEC one might be a bit more realistic in that sense.
Yeah.
We're not in a position where oil demand is dropping.
Yeah. I completely agree. But in the short term, the OPEC are forecasting inventory builds so that supply will exceed demand starting in Q1 2022. Now, if you're bullish oil, you are skeptical about this, and you think, because I think that OPEC have less spare capacity than they declare, and also they tend to underestimate demand. But if we get return of COVID lockdowns, this could all well be true.
The OPEC also come under a lot of pressure from the US, and it may be in OPEC's interests to be forecasting increase in stocks over the next 12 months.
Yes. Okay, but on to Europe's energy crisis, and I'm afraid these charts are not reassuring. So we had this week Dutch natural gas futures ticked up a tiny bit. Essentially, they're just not coming down, and the weather is not being helpful. So this is the cumulative deviation from normal being defined as 1981 to 2010. And so far is a cold winter in Germany as measured in Frankfurt. And as a result, Europe is consuming gas faster than normal. So this year is the blue line. The gray area is historic average between 2011 and 2020. So we're consuming gas earlier than normal, but we never fully refilled storage. So storage levels are in decline from already low levels. And at this rate, we could well run out of gas by March. And remember, we need 10 billion cubic meters of gas in storage in Europe just to have a minimum pressure. If there's less than that, you have no pressure and the whole system doesn't work. In addition, the European carbon price is rising and has hit a new high this week. So those factors are all putting pressure on electricity prices in Europe, which this week hit a new high. So this is French baseload power 1 year ahead, and it's shot up to a new high, and that is inflation coming down the pipe.
Yeah.
Now, this is the picture in the UK as of 7:25 this morning. So solar was not yet on, and we are generating 30% of our electricity from wind. But I thought these charts down at the bottom were revealing. And so they show how the UK has generated its electricity over the past day, week, month, and year. And you'll see over the course of the last year, about 45% of our electricity generation still comes from fossil fuels. So we need to keep on investing in natural gas production in particular. Otherwise, we are also in trouble. This is coal. It's been essentially flat in the last few weeks. Uranium seems to have come off. Richard, any thoughts?
No, I mean, it's all spiked up a little bit of speculative frenzy. I actually think the uranium thesis is intact. I do think we're going to be moving into an area of increased nuclear power usage, and therefore there is going to be a demand for uranium, which will increase the price over the next few years. I've stopped buying uranium investments now, and I'm sitting where I am. And
okay.
I'm prepared to wait for a couple of years now.
I would push back, actually. I think in the medium term, yes, you could well see a bull market in uranium, but I think we've had a bit too much speculative frenzy recently. I expect uranium to drift off for a bit, frankly.
Yeah, maybe I'll be right, Keith. So I do the industrial commodities. So a bit of a mixed week, actually, for industrial commodities. Aluminium down 1.3%, cobalt up 6%, and 108% for the year. Copper down 1.8%. We believe, so we'll show you an inventory chart shortly, that copper is marking time before it's going to start moving up again. Chromium unchanged, which makes a change because it has been going up quite significantly. Iron ore down 1.5%. Lithium, very small change for lithium, 1.5% up. Magnesium 2.2% after 132% rise year to date. Neodymium soaring, 6.7%, 233% year to date. Nickel down. Nickel has done well recently, if memory serves me correctly, and ferrovanadium has seems to have stabilized actually to around about the $32.5 dollars a kilogram level.
I just note, Richard, how green metals have had a great week. Cobalt up 6.2%, lithium, neodymium, all strong, and all, lithium's up 330% on the year. Do you want to go?
The aluminium chart is showing that the price is steady at present. Cobalt continuing its strong upward trend. Copper steady at this sort of a level, but we have some inventory charts which suggest that copper inventories are very tight, and that is indicative, I think, of a pending price increases if those inventories are reflective of the actual quantities of copper available to manufacturing industry. And the next picture.
So before you move on, Richard, the point you were making privately earlier was that previously, when inventories were low at one of the futures exchanges, they weren't low at other futures exchanges, but now they are. Inventories are low everywhere, and that has to be bullish for copper.
Yes. And this is a picture that Keith found, which is an offshore wind power cable transmitting the electricity from the offshore farm to the base station on land. And it uses 50 kilograms of copper per meter, or 50 tons of copper per kilometer. So all of these large wind farms that are being built are going to use enormous quantities of copper. And frankly, it doesn't matter whether it's offshore or onshore, it still needs that amount of copper to transmit the electricity from the wind generation field to the net, to the grid.
Yeah.
So huge demand, pending demand for copper. Chromium has leveled off, and iron ore is not. It's not a great looking chart, is it? May stabilize here, may drop further.
Surprising, actually, how much it's come off. It's down on the year.
Yeah. And lithium is continually in increasing demand as a battery metal, and showing no real sign of its pricing, of its price coming back off. Magnesium had that spike, if you remember, as Keith reminded me not very long ago, because Chinese production halted because they had their generation capacity problems, which they now seem to have overcome. So the spike in aluminium prices was very temporary. Magnesium prices was very temporary. Neodymium, a high power magnet metal used in generation and electric motors, is continuing to rise. Nickel continuing its general upward trend. Tin, inexorably, it's doubled this year, continuing in its inexorable, but to Keith and I, inexplicable rise. And ferrovanadium seems to have stabilized at around about its current price.
And onto precious metals, which have been incredibly disappointing. So this week we had lots of volatility in equity markets as fears of Omicron returned. You've seen that the fear index went big red. And you would hope that precious metals would get some safe haven buying, but they didn't. So gold was down 1.4%, silver down 5%, platinum down 4.4%, rhodium had a little bounce up 2.2%, palladium down 3.9%, and all of them have had a very poor year, despite strong rises in inflation. If we go through the charts, so gold, having had a bounce earlier, has come right off. Silver is towards its lows for the year. Platinum is towards its lows for the year. Rhodium seems to have stabilized over the last couple of months. Palladium is at its lows for the year. So very disappointing. They are not acting as safe havens. Finally, rates. Well, Jerome Powell is talking about tapering and bringing forward rate rises. So we had a small rise in the UK 5-year yield and then falls later on. Now, the UK 30 yield is back below 1%. So a reminder, UK CPI is currently at 4.2%. UK RPI is at 6%. But you can, if you lend to the UK government, they will pay you 0.9% to lend to them for 30 years. It's astonishing, massively negative real yield. Now, moving on to the Eurozone periphery, well, despite the fact that inflation is printing hot, and that must raise the fears that the ECB will have to curtail its pandemic emergency bond purchases, which would be very bad for the periphery, Greek and Italian bond yields actually fell. So this chart shows the US 5-year forwards, and that's the blue line. And it shows that they're completely unchanged over the course of the year, despite inflation relentlessly printing hot. So any correlation between inflation and bond yields has completely broken down. Richard.
So this is the high yield chart, and it shows that unlike bond yields, it has suffered over the course of the last month or so. It's dropped from 109 to 106, about a 3% drop. And Keith and I were discussing it a little earlier. It might be because of inflation expectations, or actually inflation rate. It might also be because investors are concerned that there's another hit coming as a consequence of coronavirus, and that the companies with high yield debt may suffer financially, and the safety of the debt is not as secure as it had previously been thought to be.
This is the Greek 10-year. It had a good week, but the trend is still not very nice. Italy looks a bit better, and these are still very low levels. So, but the Eurozone crisis is still there, bubbling away in the background, and the ECB is dampening it at the moment with their pandemic bond purchases. But at some stage, that has to stop. It's the UK 10-year, astonishingly low yields, and US 10-year, inflation is running hot, but they don't care. And finally, the seasonality chart, which has been torpedoed by COVID. So we will skip on. Richard, what have you been up to this week?
Thank you, Keith. So my portfolio down 1.3% in the week. My change for the year is up 9%. FTSE All Share up 10.9%. I was thinking the other day I should just have bought the S&P and done nothing. And all of my intelligence could have been devoted to, I don't know, anything else other than trying to beat the S&P, which clearly is a mugs game. So I've only made one purchase, the Sprott Physical Silver Trust, PSLV. So I am continuing with the thesis that there is an impending silver shortage, and I don't know when it will be particularly. I think that this is a long-term purchase to be held over a number of years, and I specifically went for the physical silver PSLV because I believe that the SLV, which is the ETF, doesn't actually have the physical silver, it just buys paper. And therefore, if there were a supply crunch and it ran out of silver, it would declare force majeure and would simply refund investors as some sort of cash equivalent, which is not what I want. So I have gone for the option of owning allocated physical silver. And then this is the graph of silver, which we looked at a little bit earlier. As you can see, it's in this trading range. I'm hoping it doesn't break out of the bottom of it. And this is the Sprott Physical Silver graph, which, not surprisingly, is very similar. A couple of little things. Household wealth reaches new high in crisis. Property markets and stock markets and QE. And is it really wealth, or is it just something measured in pounds? I think the two might be different. It's very similar to what we were talking about in the US. And I thought this was investing. Technology, top investors put faith in God app Glorify. I just love that. An app to help religious Christians devote themselves on a daily basis to their religion and prayer. Now, I don't have any objection to that. I just think the concept of having an app to do it is strange. I find it strange. But
absolutely.
I wish them all the success.
Actually, before we move on, Richard, I think your point about financial assets and whether they are real or illusory is a very good one, because essentially your financial assets ultimately are a claim on business, on assets. And what we've seen is that, the high price to sales ratio that you are buying means that you are essentially buying smaller and smaller chunks of productive assets for higher prices. So, hence, I've got a lot of oil companies which are on low PE ratios, although frankly, that's not improving, sadly. but I hope that I have a claim on real productive assets, which are going to generate cash going forward. Whereas if you buy, these are like Uber, etc., what exactly have you got? I don't know. Hence, I don't touch them.
Yeah, I think that's a good point. And also, you could do a thought experiment, can't you? Where you say there is one asset that has a limited supply. Let's call it. It's a share. It is has a limited supply. Everybody invests in it, and that the value of that asset soars because everyone's invested in it. Actually, economically, nothing has happened other than a small amount of cash has been exchanged, but the valuation has gone up very dramatically. So then everybody goes away and looks at their personal balance sheets, which have soared in conjunction with the asset price, and the wealth is illusory, as you say.
Yeah. Okay. Thank you, Richard. So my P&L, I was actually up 1.3% on the week because last week when we measured my P&L, we were in the depths of an oil price crash, and it's actually had a bit of a bounce since then. So 1.3% on the week, but only up 6.1% year to date, as oil has had a terrible few weeks, frankly. And so underperforming Richard, underperforming all share. But, frankly, I'm not that fussed. I mean, I think I've got good assets and my thesis remains very much intact. So,
Yeah, I think we both try and invest for the longer term, Keith, and we're not marking it to market on a daily, weekly or monthly basis, particularly.
Yeah. So, the ructions of the last week have affected me really not much at all. I'm not bothered. I had a great year last year, not as good as Richard, who had an amazing year, but, I'm very relaxed. Now, I did 2 small purchases. I added to my position in Gulf Marine Services, and I prepared a share talk on that. And Richard and I will be recording it when we get the chance. And I had a long-standing limit order in Goldplat at 7p, which had been there literally for months. And in this last week's gyrations, it got hit. And we did a share talk on Goldplat. And if you haven't seen that, please watch. So I thought I'd quickly talk about Chariot Limited because it's the example of a company that's actually managed an equity raising quite well. And you remember, long-term viewers of the podcast will remember that one of the companies we liked, Petromatad, which has an oil field in Mongolia, managed to absolutely destroy its share price through a mishandled share placing. Well, Chariot, they did a share placing at 7p, which was the price of the share price the night before. It went well, it was oversubscribed, and it's had hardly any effect on the share price. So good job. This is Gulf Marine Services, and I bought a bit more, and we will be doing a share talk on that in due course. And finally, this is Goldplat, which is a gold recovery company. I think the business has turned around and it's now kicking off cash, and hopefully at some stage it will start paying dividends once again. But and it's now my biggest gold holding.
Good.
So thank you all for watching, and for all our donors who have allowed us to buy Richard a new microphone. And I haven't got to the edit yet, but I hope it's worked. Anyway.
Fingers crossed, eh? We did a test on it, so thank you very much.
Thank you to everyone. So
and loud and clear.
If you are enjoying watching the podcast and would like to donate, then you'd be very welcome to do so. And thank you to all our donors, and details can be found in the description of the podcast. In the meantime, can you please press like and subscribe to the channel? And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Bye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.